Hey guys, welcome back to the Results Junkies podcast. We are recording this episode a bit ahead of time as Mr. Singh will be doing some traveling. Our producer Jeremiah has got spring break, and so we wanted to make sure we had some extra stuff hanging out and ready for folks. So we're going to talk a bit about a report that Carta released recently. Carta is something that actually did cause a little bit of controversy. A few weeks ago, we talked about in the show about them sharing some information they shouldn't have shared, which will be one of my follow-up questions for Paul. But before we get into that, Mr. Singh, how are you?
Doing great, man. I think by the time this episode comes out, we will have already finished up spring break with the kids and all that. Doing good, I think. If I project forward to the Paul that will exist on the date this is released, I think I will have been burnt out and ready to get back to my desk.
A
But
72% chance that the beacons will be in Matt Paulson's inbox.
oh, burn. Well, I think
It can't
I
be
think
100%.
I was gonna say, yeah. I don't know, man. I don't wanna, like, give away the date we recorded all this stuff, but, yeah, I mean, if
I
we're
do.
that far into the future yeah, if we're that far into the future, I got bigger problems, but,
Yeah. Yeah.
yeah, anyway, how are you?
I'm good. I'm good. I think this topic about Carta is topical just because I'm still really not sure where we are from an investing standpoint.
Mm.
I continue to get confused by signals that I see about not only portfolio companies, but what people are raising, who's having trouble raising, who's not having trouble raising. And then, obviously, public markets. The stock market has been pretty consistently going up and to the right, mostly based on tech company growth, while there's been, a little bit of turmoil here and there on joblessness and, you know, things still cost a whole lot. So it's been a mixed bag. Yeah.
It's wild. I mean, the it's harder to take wild swings now as an early stage entrepreneur,
Yeah.
and that it is what it is. I mean, you and I are old enough to have been through a couple of these, like, sort of boom bust cycles, and
Hmm.
the boom and the bust is rarely equally applied and consistently applied across every industry. I mean, aside from
Yeah.
maybe the housing crisis, which, equally affected a lot of people, it's not like when tech explodes that other industries explode alongside it. So anyway, it's just there's something optimistic in that it's just sort of all cyclical. But that being said, though, I think the more that early stage founders are at least aware of these sort of macro issues. I mean, this is why we talk about it, right? Is that the more they're aware of these macro issues, the smarter they can be about charting their own course, whatever that might be. Do you take the
For sure.
speculative bet on that side project now, or do you wait?
For sure.
That's
And I think understanding the financing world as it exists today is paramount to knowing whether you should bootstrap or raise, and if you're going to raise, how you should raise. I mean, there's a lot there. And I think, I definitely think there's some interesting trends that come out of this Carta info. A quick bit of housekeeping before we do that. Show at resultsjunkies.com is how you give us questions, comments, concerns, all that good stuff. He is at Paul Singh on all the social media platforms. I am at Pizza in Motion. And if you have a little bit of free time, if you're watching us on YouTube, hit that thumbs up button on the episode and leave us a comment there. If you're listening on Apple, Google, Spotify, whatever, if you leave us a review and a rating, that would be super awesome. All those things help us grow the show. And yeah, these two talking heads want to be talking to more people. So we'll link to this Carter stuff in the show notes. And there's a lot of data here. And so, like, at a high level, and this will lead to my first question for you, at a high level, they're consolidating data that they've culled from companies that use Carta for various services. And the biggest primary service that Carta offers is cap table management. So they manage both investor shares and then what I refer to as ESOP, employee stock options pools. And so they're handling employee shares, they're handling investor shares, and keeping track of all that for you, pro rata rights, all that good stuff. So my first question for you with this detailed report, State of Startup Compensation, second half of 2023, and I'm not, this isn't a loaded question. I don't have a strong opinion on this. Should Carta share the information? Because we just had this discussion about whether they should be, doing some of the stuff they were doing, create a secondary market. Are you comfortable with the level of data that they shared?
I didn't expect that question.
I'm here for you, man.
I don't know if I expect them to share more information. I mean, I guess let me just kind of shoot from the hip on this. Uh, I think I'm an average person in the sense that I don't rely on any one information source for my for
Yeah.
my info. So in other words, like I've got the Today Show on in the morning and it's augmented by, Apple News alerts that get pushed to my phone throughout the day and there's various sources. And then in my mind, I sort of piece it together about what's going on in the world. And very similarly, when it comes to startup data, whether it's, financing info, compensation, whatever, I'm thinking about, the 10 investor updates I got in the last week, this report that Carta put out, and more. So, yeah, I mean, I guess with all that being said, I don't know that I expected them to give me more. I just kind of think of this as one more data point. And in fact, one other thing I would think about is that is reiterate maybe that a little bit of what you said, which is because this is a cap table management, the data that they have is clearly going to be biased towards the types of companies that need that service. So
Yep.
when we talk about the results, like these are not going to be like you couldn't take these results that we're going to talk about and draw a direct line or a direct parallel to the brick and mortars in your brick and mortar businesses in your neighborhood or whatever it might be. So anyway, that was a long rambly answer, but yeah, I don't know. I mean, it's just another data point, and
Yeah, I think
it's
it's just a
interesting.
data point as well. I assume there's nothing in here you feel like they shared that they shouldn't have shared from founders'
Oh,
information.
no, I mean, I think I would err on the side of giving more. I don't have the report right in front of me this moment, but I I I do wish there was maybe a little bit more information on the spread of the companies. Like
Sure.
because the source data, this is all aggregate data based
Mhm.
on, whoever's put it into their system. But like they didn't really say whether companies could opt in or opt out. Because if that's true, if they could opt out, then it makes you wonder like, okay, is there survivorship bias here and other biases that
Yeah.
are there because maybe companies decided to opt out and all you're seeing is the ones that stayed opted in. I don't know. So
Well,
so I guess if I had to put an answer out there, I would say I wish there was maybe a little bit more information on the data set that this was aggregated off of.
yeah, you brought up a point that dovetails into something that I wish the information included, which was I would like to know what percentage of Carta companies they surveyed, and that might seem like an obvious answer. Well, like of course they surveyed everyone. Or maybe I should say it differently. What percentage of companies that they surveyed do they perceive as active? So, like, there are tons of companies out there that are essentially walking dead. What also happens to a company that went away during this time period but never completed the layoff portion? Because some of the inferences that they make in the report, and this is where we start talking about some more detailed report, they talk about departures and they talk about hires. And when I think of this in the context of Carta, I don't think that this necessarily tracks the metaphorical secretary who doesn't get shares. I think it tracks a lot of hires, but I think there are still some employees in these early stage ventures that don't get shares,
Right.
and so may not necessarily have a Carta account. Because typically you wouldn't have a Carta account unless you had some sort of share or option or
Correct.
pending
Yep.
distribution or something of that nature. And I mean, to be clear, Carta does offer other products that people could fall into their categories, but like this is the lion's share of what they do is the cap table management stuff. And so like so some of the stats, and this might help people understand where some of our, concern, maybe not concern, but question on some of the data. They note that hiring was down 50% from 2022 to 2023. And for perspective on numbers, for companies that are on Carta, they said they made approximately 267,000 new hires in 2023 versus 523,000 new hires in 2022. I think those numbers are big enough to be statistically relevant for sure, and likely indicate some directionality to the early stage world as a whole. Whether it's 50% down across the board, I'm not sure, but I would bet it's not 20% down or 80% down. You think that's fair?
Yeah, I think it's fair. Yep.
The other stat that I thought that was interesting that they threw out was that 32% or a third of all the new hires from 2022 have already left their company, if we're sitting here in the first quarter of 2024. And then two other numbers I thought were interesting. 43% of all hires have been there for less than 2 years, and 75% of all hires have been there for less than 3 years. I'll be honest, 75% not making it 3 years surprised me.
Well, again, context, we don't really know what the
Mhm.
underlying data set of companies looks like. Basically, what you'd have to do is you'd have to expose the funding date or the initial funding date of these companies to be able to
Mhm.
then slice. Because you're right. Like, if it's a 10-year-old company and 75% of the employees have been there for less than 3 years, that's kind of weird. But if that particular cohort of companies was funded 3 years ago, then that's essentially that's not bad, right? Because you would think that
Right, and I
it's not like they hired all of those people on day 1 of funding. It's so I
no, I think Carta's been around for probably 10 years.
right. No, no, I get that, but what I'm saying is that, like, in order for us to have an opinion on whether 75% sticking around for 3 years is good or bad, there needs to be some sort of cohort analysis that tells us, like, that
What
see,
percentage are
that
more than 3 years old, yeah.
right, exactly, because that's what's missing here is that these data points are the optimistic view here is, okay, this is one more data point that you and I didn't have before we had the PDF. The pessimistic view is, okay, this report is just a bunch of clickbait because I can't really make any decisions off of this. Like that number, that 75% number. Well, you and I, if we were to go look at our portfolio companies that we invested in 3 years ago, and then we, let's say, wanted to compare their employee retention rate. I can't even use this data because I don't know what that 75% means. Does
Right.
does that make sense?
It does, and this chart might help us to talk about this a little bit more in detail. So for folks that are watching, you can see the chart on the screen. For folks who are listening, the chart shows 3 general axes, 3 specific axes, and then 1 general. So it shows a black line for new hires, and it shows new hires spiking in late 2021, early 2022, which from a SaaS standpoint, makes some degree of sense. There were lots of companies that were piling on employees during the pandemic, and people had Zoom licenses and Slack and, Head Start, meditation, and, like, all those services that we used during the pandemic. And then, the chart shows hiring drifting down significantly such that hiring at the end of 2023 was significantly lower than it was in 2020 and 2021. And then it also shows that the people leaving by choice and the people being laid off have risen overall collectively in the past 3 years, such that right now, hiring and leaving are almost in stability at the end of 2023. And, this being they noted, even though the chart shows us a little bit oddly, they noted that this is the largest month of layoffs. December of '23 was the largest month of layoffs, larger than any month in 2019, which is on the chart, or any month in 2021. So, I mean, the layoffs thing doesn't surprise you, I'm sure, right?
No, I mean, if you were to, and I don't know the statistical term for this, but if you look at that layoffs chart or line, so we're looking at, and if you're on YouTube, you'd be able to see the screenshot here. But if you look at that time, this is time series data, and if you look at when it started to rise, it's pretty correlated to when we also started to notice that early stage fundings declined, maybe delayed by about a quarter or 2, because a lot of companies, when they are gonna go raise more money,
Yeah.
they're raising with only maybe 6 months of money in the bank, 9 months of money in the bank, so it would make sense that, if that was not successful, then about 1 to 2 quarters later, they would start to have layoffs. So, yeah, the layoffs numbers don't surprise me. I do, just looking at this out and thinking out loud, I'm not exactly sure why the layoffs line peaks in January of 2023 and then drops.
Yeah.
It
No, I
just
think
seems like
yeah.
a weird pattern there.
I think that's
I don't
interesting as well. Yeah.
yeah, so, I mean, it could be that, like, a wave of companies, like, cleared out, by that point.
End of year, yeah. There could be
Yeah.
triggers there too, because one of the things I thought about with a chart like this was, the people that got laid off in 2022, if they had options, they likely had some time period. Usually it's 90 days after you terminate from a company where you have the ability to exercise options. So in 2022, a lot of those people probably still had either the cash available or the ability to borrow to exercise those options and could make those choices. I think we've generally seen a constraint of available cash in 2023, such that I would imagine with layoffs still staying high, probably less opportunities for people to realize the upside of working for a startup, which would be to capture that equity on the way out the door.
Well, not that this is a personal finance podcast, but for the record, please don't borrow money to exercise your stock. Not a great idea.
Yeah.
Startup investing, especially early stage, is not for the faint of heart. I mean, okay, from that perspective, I would say 2 things. Number 1, that particular data point, because you have to enter the employee's end date into Carta to handle the cap table properly,
Right.
you can trust I feel like you can trust that data much more.
Agreed.
And also based on, I probably also believe their information on whether they were laid off or voluntarily departed, because that also determines that exercise period for a lot of ESOPs. So
Yep.
I believe that part. One thing I do wish, now this is the second part of this statement, one thing I wish they had maybe considered showing in the aggregate is what percentage of people actually exercised,
Would
because
love to
that
know
might
that.
also
Yeah.
give you some idea of sentiment. Were these departing employees still bullish on the underlying company? So, but anyway, yeah, the patterns though in the chart are kind of interesting, particularly that laid off line. Like, why did it decline through
Yeah.
all of 2023? That I don't know. It
Well,
just
you and you
seems
and
like
I
a weird
both know
pattern.
stories back from the days of AOL, when AOL was in its heyday, where, friends of yours and friends of mine had options from AOL, and I don't think a lot of folks had a good sense of what those options could be worth, and maybe they bought a stereo or a car or went on a vacation or whatever with those shares. But I think from an overarching standpoint, something you and I have talked about a lot on the show is that, a big part of why you go work for a startup versus going and working for, a brick and mortar establishment or the government or whoever is because of potential upside. And so if you never get to the point to be able to exercise the shares, or you leave it at an inflection point that doesn't make sense to exercise the shares, you missed one of the biggest reasons to be involved in the startup ecosystem.
Well, yeah. I mean, to be clear, if your goal is to make money, working at startups is statistically not the right way to do it. There's probably other ways to go do it. But you're right. With that being said, you're right. Like, if you play your cards right, you execute, you're part of the right team, you pick the right one, all those things have to happen.
Mhm.
As long as that happens, yeah, this is a great way to make a ton of money
But overstating the obvious, if you don't exercise your options, you've eliminated really the only way to make tons and tons of money in this ecosystem.
with the caveat that as long as you are exercising the options of a company that will go on to be worth something.
Oh, I don't disagree with you. I'm just saying if you never exercise the options,
Oh,
there's no
yes,
like
yes, yes,
you're
yeah.
never getting you're never getting
Yeah.
outsized salaries from a startup. And I hate
Yeah,
to beat it over
I
the
only
but
put that caveat in there for the listeners that don't quite understand what that means. Like, exercising stock in AOL in 1995, in hindsight, would have been very smart,
right, right.
but exercising Theranos,
There
if
yeah,
you were an
yeah,
employee
yeah,
there, that would not have been a good
yeah,
idea. So
yeah,
that's why this whole industry is a little bit dangerous too, is that
yeah.
you're making speculative bets.
Sure, the people who
Uh,
bought those stereos probably thought they'd make a great decision, and in many instances in the startup world, they probably would have been making a good decision. There was one other
yeah,
chart that we wanted to show, which I thought was interesting.
this is interesting. Yeah, yeah.
Yeah, so essentially what you've got here is you've got for folks who can't see the chart, and you can see this on our YouTube channel. Just Google results Junkies YouTube podcast. But it shows 2021, 2022, 2023, and it's done by industry segment. And so at the top of the list, energy, hardware, medical devices, and health tech were all industries that were the most bullish on hiring back then and are still the most bullish now. They're still growing, but by a much smaller count for companies that use Carta's services. And then on the flip side, companies that were almost as bullish in the beginning, consumer, ad tech, and gaming, who are actually shrinking in a relative basis at this point. Fewer employees than they're laying off more people than they're hiring as it stands today. And you had a comment in the pre-show that you think that this about why you think this is accurate.
I mean, I don't know what you call this chart, this sort of heat map.
Heat
What
map's a
would
good
you
word for
call
it.
it when it's a heat map with a time component to it? But this correlates pretty well with, what we've seen in the funding environment, the sort of the macro environment for startup investing. Consumer ed tech, gaming, arguably all three of those should actually be the same bucket maybe, but, those that kind of aligns with well, in fintech too. These that aligns with, like, sort of the drop in early stage funding, over the last 2 or 3 years, and then you can kinda see in this heat map the visual representation of that, like, it's not like all of a sudden in Q3 of 2023, it went blue. You can see the shading over time where it
Yeah,
dropped, and so
right.
yeah, you can see, like, it was roughly, like, late 2021, early 2022 when we started to see funding dry up for early stage,
Mhm.
consumer tech in general, and that correlates with when it went from orange to light blue and then subsequently to dark blue, so yeah, I mean, this sort of aligns. Arguably, even in those other industries up above, the deeper tech ones, they definitely look less worse than the blue down below. But actually, if you start to look left to right on this chart, they look like they're trailing the consumer stuff by 2 to 4 quarters.
Could be, it's hard to say. I mean, there's still some growth there in some of those sectors. I think the 2 that I found interesting were fintech, which started out at one of the higher levels, in terms of how many heads they were hiring versus laying off, call it 4 to 1, and how that they're essentially down to a negative growth rate now. And I think when we think about fintech, I mean, certainly there's been some banking scares, and then you've had all the excitement and outrage around crypto, and so there's a lot of uncertainty in that space, and we've seen obviously many companies that just went completely dark. And then right above that on the chart, SaaS, which started out, middle of the road, 3 to 1, let's call it. And they've leveled off to essentially flat, slightly shrinking. And I think I find that one interesting just because I would have thought that SaaS would have retreated a little bit more, just given, and maybe this goes back to something else you said. Maybe we'll see SaaS continue to shrink in 2024 in terms of headcount as there's this lag in companies shrinking their license bases as their contracts come up for renewal on an annual basis.
Yeah, I agree. I mean, where my head goes on this though is that okay, so directionally, I think we're kind of in agreement that it's all kind of heading towards more austerity, more, like there's less like these companies are not as bullish as they could have been, and that's probably because that they're not getting funded as now. Like directionally, this tells the right story of what I think the world looks like right now. If we really wanted to become like statistical nerds on this, I think, you could probably start taking this data out, throw it into Excel, and then start to build some standard deviations and stuff like that, and start to see which of these industries was most impacted.
Yeah,
But I don't that's not going to change the directional correctness of this chart. Like if you're a founder and you are thinking about like your hiring plan, I would encourage you to like look at a chart like this and ask yourself, you know, if you're feeling more bullish than what this chart suggests for your industry,
right.
I would have a serious conversation with your investors or your team about why you think that is. Like maybe you know something, maybe you have like, pre-orders or something that justify that bullishness. But on the flip side, looking at this chart and having that conversation might expose the fact that like you don't. And as long as if you don't, like there's no honor in having conviction and then burning out and running out of money. So, you know,
Yeah,
that's where these charts kind of really become helpful even if you don't have all the underlying data. Like I can be a stats nerd all day and say, "Oh, well, Ed, I wish they had given me this and that and whatever." But from a directional standpoint, I think founders should be looking at this and comparing it to their own growth plan. Like here's the tactical exercise for anybody listening to this right now. I would just grab a piece of paper right now before you even look at the chart. If you have not looked at the chart yet, don't look at the chart. First of all, take a piece of paper with a pen and write down how many hires, just put a number. How many people do you think you're going to hire over the next 12 months? Just write the number down, flip the paper over. Do not pass go. Do not keep going with this podcast until you write the number down. Once you've written down the number, now you go look at the chart and try to compare what you put down. You'd have to like figure out how,
yeah.
you'd have to like, but you see what I'm saying though, right? Because like
Mhm.
once you look at that chart, it's easy to be like, "Oh, yeah, that's what I was thinking too." If you actually have to now look at that chart and look at that piece of paper that you just wrote on, you can't lie to yourself. If you thought you were gonna hire 12 people and you're in SaaS, well, that seems like very out of line to what that chart says SaaS companies are doing right now.
Yeah,
So
I think the chart overall also illustrates that in this tech space, it's, headcount is, one of the biggest levers that you have to pull in both directions. And, unlike
well, it's your most
typical
expensive line item on the P&L.
it is, but only because most of these businesses are missing the items that other businesses typically have. So, my
Okay, yeah,
restaurants all have leases and they have
yeah,
utility bills and all that stuff.
yeah.
In a lot of these cases, they have server, but they're likely rented. So they're likely more of a monthly expense rather than, CapEx expenses. And so, people is the thing that they can most easily toggle on and off. They if there was server capacity to tweak, they've likely already done it before they get to headcount.
Mhm.
They've cut the sandwiches from the cafeteria, they've cut the AWS stuff they don't need, and now they're at headcount. It's a very big lever. It's a hard one to pull, but essentially it's the most powerful lever they likely have.
Agreed, agreed. So, yeah, I mean, for founders though, that the key here is use these types of data sources. Like, you just need to be directionally accurate, especially at the early stage. You don't need to be perfectly accurate. We're not doing surgeries on people. That you need to be really accurate with that. But here, this is about directionality, and that's where these data points are. These types of data or reports is really really useful. So anyway, it's all good stuff. This is good stuff.
Well, I'll be interested to hear how all of your trips go, and then when we're back on a live cadence to hear, what the ratio of margaritas to Advil was for
Yeah.
St. John's
Well,
and $18 balloon to Disney to temper tantrums.
Dana just said to me the other day, she said, "You ready to go buy" what are those, like, bubble wands called? Well, I guess
Oh,
they're
is it?
called bubble wands. Anyway,
Yeah, yeah.
she said to me in passing the other day, like, "You ready to buy some bubble wands?" I'm like, "Oh god, with 4 kids, what's that gonna cost?" It's, like, probably $200 right there.
You know what would
I'm
make it
like,
better though? If you bought your wife an annual pass and you get 10% or 20%, depending where you buy it, off of those bubble wands, and she gets to visit Disney more. So just something to think about. And if she doesn't listen to the show, she won't pick up on the fact that I'm now recommending you spend a lot of money so she can have an annual pass.
as I recall, actually, weren't the annual passes, like, shut down? You couldn't buy them for quite a while.
You couldn't. Yeah, no, you couldn't. They've been periodically going back on sale. So,
Yeah.
I think,
I do
yeah,
think that we'll
does Dana
probably
listen?
I don't think she listens.
Well, she should, because right now I'm advocating you spend money on it.
I do think we're probably a year away from our youngest being old enough to just take a weekend trip. So I think the annual passes are probably going to start making a lot more sense for us next year. I mean, you could argue that he's free right now, right? But it's
Yeah.
the logistics of putting him on an airplane and
Yeah, yeah.
pack and plays and all that stuff. So, but I think we're within a year ish of freedom to travel with him.
And look, I mean, look at the bright side. You can, if you want to spend a boatload of money to buy into Disney Vacation Club, then you get a discount on the annual pass. So now I'm spending just $1,000 a year. I'm now spending 30 or 40 grand, and then $1,000 a year. So
Oh,
you're
that's so
welcome.
nice.
You're
Wow.
welcome.
Woo, man, I really hanging out with you, it's like you're gonna spend money on, global services. Here's how much that costs. Okay, get into DVC. Okay. By the way, you want to get into the whatever that Disney club is, 1930 or whatever it's
Club
called.
33, baby.
Club 30. Here's what that costs. It's like, oh man, thanks for the privilege, Ed. I'm 6 figures in the hole now.
Well, to be fair, we're 131 episodes in, if I did the math correctly, and if it really took you this long to figure out that I am not a cheap date, you have not been paying attention.
I know.
All right, well, hope the trips
all
are
right,
great.
buddy.
Can't wait to hear the recaps.
Thanks, man. I'll talk to you soon.